Ghana's President Nana Akufo-Addo took the fight for a fair playing field for African countries to the United Nations General Assembly recently, saying that the world must reform an international financial system that is rigged against developing countries and economies. We'll also be looking at the cryptocurrency that African companies are hedging their local currencies against. Those are two of the topics we'll be treating on today's Business Edge. I'm Tolulokwe Adeleru Balogun. Let's start with the African business headlines. The Nigerian Electricity Regulatory Commission has issued 37 new permits to produce 762.3 megawatts of electricity to boost power supply in Africa's largest economy. The commission granted 4 new generation licenses with a total capacity of 508.5 megawatts and the renewal of 2 existing licenses in the fourth quarter of 2021. Approvals were also granted for an aggregate capacity of 253.75 megawatts captive power generation permits to 8 companies with 25 mini-grid permits. Nigeria and Kenya are likely to hike interest rates by a modest 50 basis points in the coming days after months of heavy lifting from other African central banks to try to calm rampant inflation. Ghana is expected to hold its rates. These week's benchmark interest rate decisions remain a very close call without any clear majority from analysts. A scarcity of dollars is fueling inflation in Nigeria and Ghana, as well as other parts of the continent like Ethiopia. Rate increases in the United States have chipped away greenbacks and weakened domestic currencies. Angola's Central Bank's Monetary Policy Committee has cut its benchmark interest rate to 19.5% from 20% for the first time since 2019. Governor Jose de Lima Massano says a slowdown in Angola's inflation since the start of the year and the appreciation of the kwanza against major overseas currencies were among the reasons for the cut. Price growth in the country dropped below 20% for the first time in more than 2 years. In August, the central bank forecast said it will slow to less than 18% by the end of the year. Kenya's central bank is under pressure from wealthy investors and financiers, including banks and pension plans, to raise the cost of government borrowing as worldwide increases in lending rates make local assets less appealing. Investors are unwilling to lend the Kenyan government billions of shillings in a push for higher interest rates, signaling a funding headache that awaits the new administration. The next meeting of the Monetary Policy Committee will be on Thursday. And those are a few headlines to get us started on today's Business Edge. Our first conversation looks at answering the question, is the international financial system rigged against Africa? Ghana's president seems to think so. We'll tell you more after the break. Ghana's President Nana Akufo-Addo held no punches at the recent 77th session of the UN General Assembly, where he called for a reform of the international financial system. Akufo-Addo said that the world's financial structure is skewed against developing economies. He believes that the international financial market structure appears to have been designed to favor rich and powerful countries against the interests of developing countries like Ghana. President Akufo-Addo says if the global financial structure can be reformed, it would bring about a level playing field for all countries and will give Africa the opportunity to improve its economy, grant equal access to funds, and change the perception of the continent as being a high-risk investment zone. Joining the conversation from the United States is Dr. Josh Bamfo. He's partner and head transfer pricing and economic advisory services at Andersen, Nigeria. Dr. Bamfo, welcome again to Business Edge. Thank you for joining me.
Thanks, Tolulokwe, for having me.
So as we get this conversation started, President Nana Akufo-Addo is saying something we've been discussing for a while, and also what we've heard many African leaders also talk about as well. And many leaders and analysts are not happy with how hard Africa has been dealt the hand it has had in a number of years. So let's first hear from him, and we'll get into the first question.
It has become clear, if ever there was any doubt, that the international financial structure is skewed significantly against developing and emerging economies like Ghana. The avenues that are open to powerful nations to enable them take measures that would ease pressures on their economies are closed to small nations. To make matters worse, credit rating agencies have been quick to downgrade economies in Africa, making it harder to service our debts. The tag of Africa as an investment risk is little more than, in substance, a self-fulfilling prophecy created by the prejudice of the international money market, which denies us access to cheaper borrowing, pushing us deeper into debts. The financial markets have been set up and operate on rules designed for the benefit of rich and powerful nations. And during times of crisis, the facade of international cooperation under which they purport to operate disappears. These are the savage lessons that we have had to take in as the world emerged from the grip of the coronavirus to energy and food price hikes and the world rise in the cost of living. The necessity for reform of the system is compelling.
And you can see and hear some very strong and compelling words there from Ghana's president. So let's start with the claim he has made, or the accusation he's made really against the international financial system. Do you think there is some validity to the criticisms of how this system has operated so far, particularly when it comes to developing economies, to African economies, and even the African continent?
Yeah, thank you very much. I think clearly there is some validity in the position that President Akufo-Addo of Ghana has made. And he's not alone in making this particular case. In fact, I was reading an article written by a renowned professor from the well-known Ivy League University, Columbia University. And this is a professor, Professor Jeffrey Sachs, who has actually advised, General Secretariat of United Nations in the past. So there's validity to it. And the basis of this is pretty simple. The truth of the matter is the global financial system is in place to actually facilitate funds, to key players such as nations in order to help with investment in key areas. So if you look at developing countries, they clearly have much bigger needs in terms of development in key areas of the economy. One being in human capital in the form of education and health. Two being infrastructure in the form of power, roads, and part of transportation in general, digitalization, urbanization, and so on and so forth. And thirdly, to attract foreign direct investment to create businesses. So they have the much bigger needs, and they are the ones supposed to catch up with the advanced or rich economies. So where you have a system that is structured like that, right from the onset, by being a developing country or a poor nation, the credit rating agencies already put you in a position of a sub-investment grade, country in terms of your credit rating. Then whenever there's any exogenous shock, which is global in nature, which is of no fault of theirs, which is the developing countries, what these credit rating agencies do is immediately further downgrade you, which has the effect of, one, not giving you access to the capital markets, which these developing countries clearly need for the investment purposes. And two, even if you can have access, then you're going to get access to this at very high interest rates that are not sustainable. So clearly, by virtue of you being a relatively poor country, you are put in a bad situation, whether or not your economy has a clear high growth trajectory, that you can actually pay off some of your debt in the future. So I think the trumpeting of this issue has become very necessary today because of where we find ourselves with this global economic crisis, where more and more developing countries, after the COVID-19 lingering effects, actually need these funds more than ever. However, these credit rating agencies have downgraded their credit ratings, and therefore they cannot either access the capital market or they have to access it at a high cost because of huge risk premiums added by the investment community. So that is where this whole argument is coming from, and he's not alone in making that particular position.
So we'll come back to the issue of the credit ratings agencies, but I want to just expatiate. When we say this international financial system, it sort of seems like a gray boogeyman or a vague term. So it's quite necessary for us to also establish what this system is, what it's made of, who are the players that really operate and sort of make the rules in this space. So Dr. Bamfo, help us break it down. When we say international financial system, what exactly is that?
So the whole word, a system is made up of different components that come together to make it work. So when we look at the international financial system, or what is called the global financial system, it's actually made up of different key players. So think of it this way. First and foremost, it's a bunch of legal agreements that are set up for institutions such as, official institutions such as the IMF, such as the World Bank and other international financial institutions, as well as some players in the private sector, such as central banks, and other intermediaries, all of them coming together with the other institutions like the credit rating agencies that create the necessary infrastructure to make the system work. And they come together to actually manage and facilitate the transfer of funds, in the form of financial capital for investment purposes. So clearly, each economic actor, whether you are part of the global international financial institutions such as IMF, African Development Bank, and what have you, or you are part of the private sector players, which is the central banks and other intermediaries, or you are part of the infrastructure that actually helps, facilitate these transactions, such as the clearing houses and all that. You all play a role in facilitating the transfer of funds from those who have, access and to those who have a need, just like how banks work in each economy. So that is basically what it is. So if there are rules that the credit rating agencies or the central banks play by, that from the onset, is to the detriment of developing countries having access to reasonably priced, capital, then that actually goes against that particular group of people or nations, which is the developing countries, and the ability to access these funds and be able to make those investments in their countries.
Okay, so when we take this further, another thing that President Akufo-Addo said was also that the avenues that are available to rich and powerful nations to also enable them to take measures that would ease some of the pressure on their citizens are not available to developing economies such as Ghana and those on the continent. We've talked about the credit ratings agency and how they then affect African economies on the international market. But what other avenues and options is he referencing that seem to be closed? The doors to those avenues and options are closed to African economies, particularly at a time like now, where inflation is just running away from almost every single government on the continent.
So when you look at the very rich countries, for example, United States, in fact, these bonds that we are looking for, which is the international and the foreign denominated bonds, all right, are actually mostly denominated in their own currencies. So if United States has a need to borrow, which almost every nation does, right, and they decide to float new bonds in order to generate those funds for investment purposes, they don't have to actually clamor as much from the private sector to actually buy their bonds. In fact, the Central Bank of the United States, which is the Federal Reserve, will be the major buyer of those bonds in the open market. So they don't have that particular challenge. So they make an open market purchase and they're able to demand this. And the US is able to refinance or reissue new bonds in order to make their investment needs. The same can be said for Euro. So you have the European Central Bank playing the role of a lender of last resort for members of the European zone. In other words, if any member has a significant need, to issue new bonds or refinance their existing bonds, the European Central Bank is going to play that role of being a big buyer of those bonds that enables them to refinance, without being fully dependent on the private, sector of the global financial system. But that avenue is not open to African developing countries and other developing countries because we don't have this very large, well-funded central banks to be able to back some of these refinance and bonds that we might want to reissue in order to push the full payments of these bonds into the future and allow us to continue to raise funds in this international market. So what he's essentially arguing that these developing countries have this avenue, that in fact, some of these matrices that the credit rating agencies might be using, all right, in order to downgrade, some of these developing countries might not be applicable to these rich and powerful nations, whereas it's applicable to us. So it's clearly important that some of these factors are taken into consideration, given the objective of international cooperation within the global financial system and the needs and challenges that developing countries face. I think that's where he's coming from, and he's saying we don't have those avenues. So we need to really overhaul this global financial system to come up with creative avenues that developing countries can actually tap into, and therefore do not be at a total disadvantage. And that is basically where it's coming from, and I fully agree with that perception.
So let's talk about one of the challenges that I found it interesting that the Ghanaian president raised. And he talked about the tag of Africa as an investment risk and how that particular sort of description or descriptor has now turned into a self-fulfilling prophecy created by the prejudice of the international money markets, which then, of course, Africa is a risk. You then deny Africa access to the international markets. You make investors think twice as well. But from your standpoint, there's risk in any form of investment, as it may be. How much of a risk is Africa? Or is Africa truly the risk that it seems the international market tends to make it seem like?
So the argument is very clear, right? So by virtue of you being a developing country, and most African countries are developing countries, these credit rating agencies will tag you as a sub-investment destination, period. They don't really take into consideration your growth projections, because a country can be a developing country, but could be on a healthy path in terms of development. That if you factor in that major factor, then you might not target as a sub-investment grade country per se from a risk perspective. So the argument is right from the onset, by virtue of the fact that you're a developing country, you are tagged as a sub-investment, risk credit rating country. And then when there are shocks, such as this COVID-19 shocks, then they downgrade you. So you start from a very poor position, and then it worsens when there are these shocks without any due consideration to your potential, or whether you actually are on a path to insolvency. So that is the problem. So when there's a shock and you then downgrade, already by virtue of them being a developing country, you give them a bad rating. There's an exogenous adverse shock, you downgrade it, which makes the interest rates higher, or they don't get access to this capital market, then definitely cannot refinance their bonds. So they have to make significant, economic meet significant financial obligation. And that can actually lead to the default. So it becomes self-fulfilling. However, the counter argument is, if these credit rating agencies can actually factor in other very important, indicators, such as growth potential, the fact that this is a transitory period, that, if they can actually get access to cheaper loans, they can actually get back to high growth rate. Look at Ghana's example, right? Since it's coming from the NAD. Prior to COVID-19, this was a country that was touted to be growing very well within the global economic community. Their GDP growth rate was around 7%. Inflation was at single digits. However, they couldn't really deal with the shock of the COVID-19, especially when it came to their debt situation. So debt to GDP ratio rises from around 60% to almost 80-something%. All right. Then you further downgrade such a country without consideration to its potential, the fact that they were on a high economic growth rate. And if they can have access to these international capital markets, they can actually rectify their situation and get back to the high economic growth rate. But by not being able to access the capital market, you rather worsen their case, then there could be a possibility of default. Then the gains that they made are reversed, and they find themselves in this financial trap where they can't actually get back to accessing international markets. So that is the concern, and that's the whole argument of this self-fulfilling prophecy, that if we don't make changes, then what you do is that I predict you're going to default, and I take an action that actually makes you default, as opposed to I see that you have a potential, I give you an opportunity to access the market, then you recover, you turn the economy around, and get back to high economic growth rate part again. So those are the two arguments.
I find it really interesting because we've had the conversation about the big three, about the global ratings agency, the pushback they've also received. We know that Ghana's Minister of Finance, Ken Ofori-Atta, made some very stinging comments about one of the ratings agencies earlier this year. But what's changing? Because in as much as we might be hearing from Ghana's finance minister, Ghana's president, and a number of other African leaders and economists as well, are we seeing an acknowledgement from those who are controlling the financial systems, from people like the big three, that there is something wrong in how they are examining, indicating, serving up reports and analysis for the African continent? Which takes me to a joint question I hope you'll also be able to answer. As much as the president has listed these issues, he didn't really fully go into the kind of reforms we should look for in the international financial market to give Africa a fair hand, a level playing field, and a fair shake at things. So are we seeing acknowledgement from those international players that there's something wrong in how they're dealing with Africa? And then what's the way in which we can change this system so we don't see these self-fulfilling prophecies of doom come to be for so many economies?
Yeah, I think, General, there is an acknowledgement because there are independent, academics that have written very clear articles on these issues, some of them being advisors of some of these international financial institutions. So clearly there's this acknowledgement. The question is whether there's the willpower to actually carry out some of these changes. Let me just give you a bit of data so that we can really put some of this into context. So for example, Ghana's debt to GDP ratio as of December 2021 was around 81%, right? And its credit rating by Moody's was B3, which is a much lower rating than a country such as Greece, which debt to GDP ratio as of this similar period was around 206.7%, more than twice that of Ghana. But its credit rating was BA3, which is way better rated than Ghana. Now, Ghana at the time could access the international market at an interest rate of 9%, whereas Greece, which has 206.7% debt to GDP ratio, could access the same market at an interest rate of 1.3%. That is clearly unfair.
Yes.
Now, if you throw in Portugal, debt to GDP ratio was around 130.8% around the same period, and it was accessing the international market at 0.4%. So these are some of the issues that not only the leaders of African countries are lamenting about, but other academics and economic players are also lamenting about. So what are some of the recommendations that have come up? First and foremost is the recognition that the credit rating agencies have to take into account other factors based on the growth potential of these developing countries in coming up with their credit rating, so that they are not quick to downgrade them when there are these exogenous external shocks, such as the COVID-19 and pandemic impact. So really looking at that growth potential is going to be important. The second is the fact that, look, the rich countries have the advantage of having the backup of their central banks. So if you look at the US, the Federal Reserve, the Fed is able to support them as lender of last resort and is able to actually demand the bonds that they refinance or they introduce in the open market. Now, when you go to Europe, you have the European Central Bank being able to back them up. When you come to Africa, we don't have such backups. Our central banks are not, well resourced with, international reserves to be able to back us up when we try to refinance in these very dire situations. So one of the recommendations that have been made by this professor, Professor Jeffrey Sachs, D-Sachs, is that the IMF, the International Monetary Fund, and the G20 should actually consider creating a secondary market where they are able to actually trade, or these developing countries are able to issue their bonds, and then they are able to have access to funds and make sure that such market is liquid, so that when there are challenges in the primary market, they can still be able to access funds in this secondary market. I think it's a creative idea to actually deal with this, because they don't have the same backing that some of these rich nations do have. So these are some of the considerations that have been recommended by academics. And I think it's about time that the IMF, the G20, who actually want to make sure that the global financial system works, and we don't want African countries to be left behind, look into some of these recommendations and implement them so that we have a level playing field, and these African economies can actually play catch up in terms of their high economic growth and be able to catch up with the rich nations. If not, it's going to be very difficult for them to play catch up.
All right, Dr. Josh Bamfo, I think it's a conversation we'll continue to come back to over the coming months. We're seeing a lot of it sort of, really step up gear and take more with the president of Ghana taking this to the UN General Assembly, and we look to see what results come from it. Thank you, as always, for joining me.
Thank you very much, Olopez.
All right. And not only was the international financial market or system brought to book at the UN General Assembly, it was also a time for African countries to demand for more permanent seats on the Security Council. So there's a lot of conversation about Security Council, our debt as well, and even Africa having a fair playing field on the international markets. And we're going to see a lot more of the conversation surrounding this, with people putting down recommendations and demanding that there is some level of change. The change I have for you is a quick timeout, and after that timeout is international business news. Stick around.
My name is Olatunji Shotimiri, and you're watching News Central TV, Africa First.
My name is Otumba Mufu Onifade. This is News Central, Africa First.
My name is Israel Ebel, National President of NANTAP. NANTAP is the National Association of Nigerian Theatre Arts Practitioners. You're watching News Central, the Pan-African television, Africa First.
On the international scene, sentiment among German exporters fell in September to its lowest since the early stages of the COVID-19 pandemic, as the slowing global economy dampens any expectations of growth in the medium term. The Leibniz Institute for Economic Research, based at the University of Munich, found exports expectations dropped to minus 6.0 in September from minus 2.8 in August, the lowest since May 2020. Exports from Europe's largest economy decreased 2.1% in July from the previous month, hit by sinking demand from Germany's two most important trade customers, China and the United States. The Irish government is expected to unveil its budget for the coming year today, which will detail its plans to deal with widespread problems caused by the cost of living and energy crisis. Finance Minister for Ireland's three-party governing coalition, Paschal Donoghue, will reveal the spending measures by midday in the Dáil, the state's lower house of parliament. The date for the budget announcement was brought forward by 2 weeks because of the urgent need to deal with inflationary and supply chain pressures on households and businesses. Banks and other financial institutions in Australia will pay about $7.2 billion to customers as a result of wrongdoing. The deputy chair of the Australian Securities and Investments Commission, Karen Chester, said the regulator wanted to stop its hands-on involvement in remediation schemes, a program that's been underway since mid-2010 when widespread misconduct in the sector was first uncovered. The regulator launched a new guide for remediation programs on Tuesday that Chester said she hopes would put a limit to frivolities. The U.S. dollar lost a little of its strength on Tuesday after starting the week by surging against major peers, including a record high versus the pound, though equity traders struggled to claw back recent losses owing to recession fears. While central banks around the world are ramping up interest rates to fight inflation, the main focus is on the U.S. Federal Reserve's increasingly hawkish tone. This has seen it unveil 3 successive hikes with a warning of more to come. This has seen investors pile into the dollar, sending it to multi-decade peaks, which have rattled governments from Tokyo to Beijing and London. Speculators are betting the UK's pound will slide to a level that was virtually unthinkable in recent decades, that is about $1 or less, after the pound tumbled as low as $1.04 on Monday, the weakest on record. Options markets show traders expected to keep falling. The 3-month risk reversal contracts against the pound are near the most bearish since 2016, while others show a 43% chance it will hit $1 before the end of this year. At the same time, analysts at banks, including Morgan Stanley and Nomura International, said they expected to touch or cross that threshold. And when we come back after the break, the conversation is on the crypto that African companies are hedging their weakening currencies against. And we'll also talk about a proposal to reverse Ethereum transactions. Will it find some way forward in the crypto space? We'll get into that after the break.